Hey everyone, and welcome back to the channel. In today's video, I'm going to be sharing how to get the best and lowest mortgage rate possible when buying your first home. So if you're new to the channel, my name is Enrique. I'm a mortgage broker based in Southern California, and I wanted to make this video for you guys sharing different strategies that you can implement regardless of what loan program you're using in order to save thousands on interest and get the lowest interest rate possible. So if that sounds interesting, make sure you stay to the end of this video. Without further ado, let's get started. All right, number one is going to be your credit score. Now, this is something a lot of people know, but let me just break it down for you guys so you guys can actually see how impactful this is, because it's one of the major contributors that determine whether you're going to get a higher or a lower interest rate. So here's an example. This is a test scenario for someone that had a 680 credit score and someone that had an 800 credit score. So for the test scenario, the person that had a 680 credit score was qualifying for an interest rate of roughly 6.9%, whereas the person with the 800 credit score was qualifying for an interest rate of 6.3%. So what does this mean? Well, for an $850,000 home, that would be a monthly savings of roughly $350 a month, just because this person had an 800 credit score. So you can see it's a big difference, not just in interest rate, but also the amount of money this is going to save you in your mortgage payment. I would recommend having a 760 and above to get the best rates possible. All right, number two is putting a bigger down payment. Now, this is actually one I don't recommend, but it is a tool, it is a strategy that you can use in order to get a lower interest rate. So when putting a bigger down payment, the bank sees that as, hey, we're going to have less risk because they're putting a larger down payment. And with loans, whenever there's less risk for a bank, it's a lower interest rate. Whenever there's more risk, there's going to be a higher interest rate. So in this case, because you're coming in with, let's say, 20% down instead of 5% down, they're more willing to give you a lower interest rate. And here's an example based on that same scenario that we did earlier with an $850,000 home. So someone putting 5% down would get an interest rate of roughly 6.3%, and someone putting 20% down would get an interest rate of roughly 6%. Now, what does this mean numbers wise? Well, that would be a monthly savings of roughly $900 a month for the person putting 20% down, and they would be saving roughly $200,000 in interest over the span of that 30-year mortgage. While you're probably wondering, Enrique, that's a lot of savings. Why wouldn't I put 20% down? The reason I don't usually recommend putting a larger down payment, even if you have it, is because in this case, you're gonna put $170,000 more in down payment for the home, roughly, in order to save about $900 a month. I'd rather put 5% down and keep those extra $150,000 or $170,000 in my pocket than save just $900 a month. All right, number three is working with the mortgage broker. What's a mortgage broker? That's a loan officer that works with multiple banks. For example, I'm a mortgage broker, and at my company, I work with over 180 different banks, or 170. It's some crazy number, right? And what that's going to allow you to do is I'm going to take the application and I'm going to shop all these different lenders for you. That way I can see, hey, who's giving my client the best interest rate possible based on their specific profile, right? Because just because one bank, is going to give you a 6% doesn't mean another bank won't give you a 5.8 or a 6.2 or a 5.1. Right? That's why it's very beneficial to work with the mortgage broker, because they have all these options of banks so they can get you the lowest interest rate possible. Now, there's also other types of loan officers, in case you're wondering, well, Enrique, my loan officer said he's going to do that. Well, there's three different types of loan officers. The mortgage broker is the one that I just explained, where they shop with different banks. Then there's a direct lender. A direct lender is someone that works under one bank that just does mortgages. I actually started as a direct lender, and the reason I left being a direct lender was because my interest rates were always higher than mortgage brokers because I wasn't able to shop different banks. So if you're working with a direct lender, maybe go out and check with a mortgage broker. They may be able to get you a lower interest rate. I would say maybe 99% of the chance they can get you a lower rate. The third type of loan officer is a retail loan officer, like Wells Fargo, Chase, US Bank, etc. These guys, they'll have good rates sometimes, but they're very strict with their guidelines. So that's a quick summary of the 3 different types of loan officers. But again, I recommend the mortgage broker because they can get you the lower rate by shopping different banks. All right, number 4 are discount points. What's a discount point? That's where you pay money in exchange for a lower interest rate. Now, the nice thing about this is that number 1, you can pay that money, and number 2, the seller can pay that money. Because if you're thinking, Enrique, well, why am I going to pay money to get a lower interest rate? I don't want to pay that. It's all about getting a lower interest rate for free. Well, the seller can also pay for it. These are called seller credits. When a seller agrees to pay for a portion or all of your closing costs, including these discount points. So how do these discount points work? Well, it varies between loan programs, but essentially the basics are the bank will offer you a lower interest rate in exchange for a certain amount of dollars. For example, they'll say, hey, interest rates are at 5%. We'll give you a 4.5%, but it's going to cost you 2 points or 2% of the loan amount. So I don't always recommend it, especially if you're going to pay it. But if the seller's going to pay for it, then really it's 50-50. It's up to you if you want that money to go toward your existing closing costs or you want to use it to buy down the interest rate. Now, quick note about seller credits. It's very, 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 very important you're working with a great realtor so they can get you these seller credits because they're the ones that are going to negotiate seller credits. And if you're working with a real estate agent that doesn't have experience, likely they're not going to get you very much, if not at all, any seller credits. And if you're not getting seller credits, you can't get a lower interest rate. So keep this in mind when you're shopping or looking for agents to work with. Do they have great negotiating skills? Are they great agents? Because that's going to determine how much money you get for your seller credits, how much money you can use to get these discount points in order to get a lower interest rate. All right, number 5 is having everyone's credit score on board. What do I mean by that? Well, when you're getting a mortgage, it's very different than like getting a car because when you're getting a mortgage, the bank's going to choose your middle score. We all have 3 scores, Equifax, TransUnion, and Experian. The bank's going to choose the middle for you. But when there's more than one person, they choose the lowest of the middles. So let's say you have a 720 middle score, but your partner has a 650. The bank is going to use the 650. And like we talked about in the first point, FICO score is very, very important for getting a lower interest rate. So you want to make sure that everyone's on board that's going to be on the mortgage application because whoever's caught last, that's the credit score that they're going to use. And even though you have an 800, the bank's going to use the 650. So make sure everyone's on board that will be on the application and shooting for a 760 credit score and above. And that's pretty much it for today's video. Hopefully you guys enjoyed it. Comment down below what you guys thought. Leave a big thumbs up and I'll see you for the next one. Be great.